friends, welcome to my channel. This is CA Raki Agarwal. Today's topic is related to NDS 8, that is change in accounting policies, estimates and error, which means that if any change arises in accounting policies or in estimates and error, the company should give a proper disclosure. Why this disclosure is required? In order to reflect the true and fair view of the financial statement. So, today's topic we will cover the disclosure of change in accounting policy, its treatment in the financial statement, disclosure of change in accounting estimates, its treatment in the financial statement, and disclosure of change in accounting errors and its treatment of error in the financial statement. So let's start our topic. First, we will cover what is the definition of accounting policy. What is the policy? Policies, accounting policies are set of accounting principles. They are the accounting principles, they are the conventions, basis of recording of a particular transaction in the financial statement of the company. So what is the accounting policies? Accounting policies are the set of accounting principles. They are the conventions. They are the basis of recording of any particular transaction in the financial statement of the company. So let's give some of the examples of the accounting policies, like property, plant and equipment, which we'll study in India 16. What it says and how its policy is to be stated in the financial statement. If the company adopt or apply whether a cost model or revaluation model, it should be disclosed in the financial statement. It's a policy. Which policy the company is required to be applied? It depends on the management whether he will apply the cost model or evaluation model for the recording of property, plant and equipment. The company needs to give this disclosure, and these are the accounting policies in the financial statement. Property, plant and equipment, whether the company has applied the cost model or revaluation model, it's a kind of policy, accounting policy. So in cost model, whether the company recognized that cost, or in revaluation method, whether the company has recognized its property, plant, equipment at fair value. So these are the policy. Which policy the company has followed is to be disclosed in the financial statement. And then intangible, it will be discussed in detail under India's 38. Then company is supposed to provide the accounting policy of intangible in the financial statement, whether those intangibles are recognized at cost model or evaluation. Cost model, company should recognize at cost, and revaluation method model, company should recognize at fair value. It should be disclosed by the company as a policy. These are the policies of the company which should be disclosed by the company in the financial statement. Inventory, whether the company has recorded its inventory at FIFO method, weighted average or cost. FIFO is to be means first in first out. Weighted average means average purchase cost during the year, and cost means standard cost. Accrual method or cash basis of accounting. Company is supposed to give disclosure in its financial statement whether they are following accrual method of accounting or cash basis of accounting. Means company is supposed to give disclosure in its financial statement. Company needs to give the disclosure in the financial statement whether they are following accrual method or cash basis. So these disclosures are kind of policies, means what method the company has adopted while preparing its financial statement, whether cash basis or accrual method. These are the policies. Inventory is prepared by taking which policy, cost method, LIFO, FIFO, whatever the method is to be disclosed in the financial statement. Intangibles is to be recognized at cost model or evaluation model. It should be disclosed. Significant accounting policies need to be disclosed in the financial statement. Means if any policies are very significant, if the change in policies are very significant, It needs to be disclosed in the financial statement. Accounting policy must be applied consistently over the period. It means that the accounting policy should not be changed period after another. It should be consistent over the period. The policy which is applied by the company, it should be consistent over the period. It should not be changed. It should be consistent. So the policy which is adopted by the company, it should be consistently followed for the period after period. The policy which is adopted by the company should be consistent over the period. Change in substance of transaction. Change in the substance of transaction does not mean the change in accounting policy. If there is a change in substance of transaction, it does not represent that it is a policy. It is a change in accounting policy. It means it is explained via example that if in a case of convertible preference share, earlier company was recording such preference share as equity under Indian GAAP. But due to the change in GAAP, it should be classified as liability. Such changes shall not result into change in accounting policy. It means that convertible preference share before applying a Ind AS means at the time of Indian GAAP, then the convertible preference share is to be recognized as equity. That is, convertible preference shares is to be recorded as equity in the financial statement as per Indian GAAP. But after adaptation of Ind AS, it should be recognized as a liability. It should not be recognized as an equity, because in Ind AS it should be recognized, convertible preference share should be recognized as a liability, not as a equity. And such kind of changes not results in the change in accounting policy. It is change due to the classification of head, but not classification of head does not result in change in policies. So such change does not account for change in policies. Accounting policy to be determined as per respective standard and as per the substance of transaction. So policy should be determined as per the respective standards. What the standard says, it should be determined accordingly. The policy should be determined accordingly according to the respective standard. So policy should be determined as per the respective accounting standard and as per the substance of transaction. Then when the company can change its accounting policy. If the company wants to change its accounting policy, the company can change? Yeah. Company can change its accounting policy only if satisfied these two conditions. What are the conditions? If such conditions, such change is required by the statute, by the law, then the company can change its accounting policy. And if such change will result in more reliable and better presentation of transaction in the financial statement, then only the company can change its accounting policy. The company can change its accounting policy only if satisfying the following condition. What are the conditions? Such changes is required by the law, and if such change will result in more reliable and better presentation of transaction in the financial statement. Such changes in accounting, if any change made in the accounting policy, it should be recognized or it should be account for retrospectively. It means that if any changes is made in the financial year 2021, then it should be restated. Previous comparative figures is to be restated. Means it should be restated retrospectively. Means the current year, previous year, then prior to previous year. It should be restated. So such changes in accounting policy needs to be accounted retrospectively. Retrospectively means it should be restated in the current year and in the previous year, and also at the beginning of the previous year, prior to previous year. If 3 balance sheet is to be given, For example, if before 1st April 2021, company is following. For example, I am giving one example. Before 1st April 2021, company was following FIFO method of inventory valuation. And after, means as on before April 21, company was following FIFO method of inventory valuation, and after April, the company has changed its inventory valuation from FIFO to weighted average method. So it's changing its policy from FIFO method to weighted average. So the change in, suppose the company has changed its policy from cost model to revaluation model. So company can change its policy from one to another, but the effect is to be given retrospectively. The change in accounting policies effect is to be given retrospectively. And once the policy is to be adopted, it should be adopted consistently over the period. What are the exceptions? Suppose the company has changed its method of depreciation from straight line method to SLM. Suppose the company has changed its method from straight line method to WDV or from WDV to SLM. Any of the, suppose the company has changed its method of depreciation from straight line method to WDV and vice versa, then such changes shall not be accounted as change in accounting policy. Means change in method of depreciation from straight line to WDV is not an accounting policy, does not result in the change in accounting policy because it's not an accounting policy. These changes shall be accounted as change in estimates because these are the estimates, these are not the policies. Change in method of depreciation is an estimate, it's not a policy. That's why if the company has made any change in the method of depreciation from SLM to WDV and vice versa, does not accounts for change in policy, it is accounted as change in estimates. The above difference is also no carve out, means there is a difference of application as per Indian GAAP and as per Ind AS, because till 31st March 2016 the above changes in the method will be accounted as change in policy as per Indian GAAP, and in Ind AS it will accounted as change in estimates. But from 1st April 2016, this gap difference does not exist. It means this carve out does not exist as of now, but the carve out is what? The change in WDV to SLM means the change in method of accounting of depreciation from SLM to WDV or WDV to SLM. It accounts for policies as an accounting policy as per Indian GAAP. But after application of Ind AS, it will accounted as estimates. It will no more exist as a accounting policy. It will treated as an accounting estimates. And in Indian GAAP also from 1st April 2016, it will be converted as accounting estimate from accounting policy. So these gap exist, these carve out exist till 31st March 2016. After 31st March 2016, these carve out does not exist. As of now, these carve out does not exist. There is no difference in Indian accounting standard and as per Ind AS. In Indian GAAP and as per Ind AS, both are for treating this change in method of depreciation from SLM to WDV, WDV to SLM as an accounting estimate. This will not be treated as accounting policy as of now. So these are the these carve out does not exist as of now. Now, treatment of change in accounting policies in the financial statement. How the company will treat if it makes any changes in accounting policies in the financial statement. What treatment it will give in the financial statement? Now, change in policies due to introduction of new standard. Suppose if any change the company has made due to introduction of new standard. For example, we are taking the example of Ind AS 115, Ind AS 116. Ind AS 115 is related to revenue recognition and Ind AS 116 is related to leases. So if this standard, these are the new standard, and if the company has changed its policies due to the introduction of these new standards, how the treatment the company will make in their financial statement? They will make the effect of transitional provision. Firstly, transitional provision of applying new standard is provided in the respective standard. It means that, like for example, new standard 115 and 116 is introduced which results into change in accounting policy. So if the effect of that change in policy at the time of transition in the financial statement should be provided. Means up to 31st March 2018. For example, we are explaining by example. Suppose up to 31st March company was following Ind AS 11 and 18 for revenue recognition, which deals with revenue recognition, because this 115 which relates to revenue recognition is effective from 1st April 2018. Before that, the company is following Ind AS 11 and 18, which is also deals with revenue recognition. But after Ind AS 115, a new standard introduced which relates to revenue recognition, and after this new standard, the old standard does not exist anymore. This movement from old to new standard is to be considered as change in accounting policies, and this is also known as a transitional provisions, which affects into the change in accounting policies, and the effect of that transitional provisions should be given in the financial statement. And the transitional provision is not provided, then what we will do, what the company will do, then the change in accounting policy to be applied retrospectively. Means if the transitional provision is not provided, then change in accounting policy, the effect is to be given retrospectively, and third balance sheet required to be given. Provision is not provided and the company has made the change in policy, then it should be applied retrospectively, and the third balance sheet is required to be given. And in case of new standard, only in the current year that effect is to be given. Voluntarily, if the company voluntarily change its policy, then the change in accounting policy due to voluntarily, then its application in the financial statement is to be made. Then also it should be made retrospectively. The changes, the effect of that change is to be restated retrospectively, and the third balance sheet required to be given. Effect of transitional provision should be given in the financial statement in two ways. How the effect of transitional provision should be given in the financial statement? It should be given in the two ways, whether the full retrospective approach or modified approach. What is full retrospective approach means? The effect of transitional provision should be applied in the comparative period also, means it should be restated in the comparative period and also in the prior to previous year. Means comparative statements are also restated in full retrospective approach, and in modified approach only the effect is to be given in the current period and not in the comparative period. In retrospective approach, the prior period figures are also restated, and in modified approach only the current period. The effect of transitional provision should be given in the current period only and not in the comparative period. Voluntarily change in accounting policies. Voluntarily, company can change voluntarily its accounting policies if it is required by the law in order to reflect true and fair view and or presentation in the financial statement for better and reliable presentation result into more relevant information about the effect of transition. So company can voluntarily change its policy also if it is required by the law, if it reflects the true and fair view or better presentation of the financial statement, if it reflects a reliable presentation, results into more relevant information about the effect of transition. And the voluntary changes to be in the policy is to be made retrospectively, and third, balance sheet is required to be given. Reclassification from one head to another head does not result into if the company reclassify its head. For example, the company reclassify its head from one head to another does not result into a change in policy. Suppose previously the company used a building as administrative purpose for official use, and then it will be treated as property, plant and equipment, that is the property of the company. And after some time the company uses that building for renting purpose. It provided its building for on rent. So it's change its head from PPE to investment property. So that change in the nature of operation of in the nature of the use of the building results into the change in head, that is from PPE to investment property. So that change does not result into a change in accounting policy. If the change in functional currency is there, that does not result into a change in accounting policy. This will determined as per Ind AS 11. Standard issued but not yet effective. So how the company had made disclosure of that standard in the financial statement. Whether the company need to give the disclosure of that standard. Yes. Disclosure in the financial statement needs to be given for the standard issued but not yet effective. Suppose the standard has issued on January, but it will effective on April. So whether the company who is preparing its balance sheet on 31st March, he will get the effect of that accounting standard in the financial statement. Yes, the company has made a disclosure in the financial statement of this standard issued but not yet effective. Fact should be disclosed why the company has given this disclosure. The fact should be disclosed in the financial statement. Reasonable estimated information relevant to assessing the possible impact about the application of new standard will have on the entity's financial statement. Means what was the possible impact on the by applying the new standard on the entity? What was the reasonable estimate is to be disclosed in the financial statement. So reasonable estimated information about the impact of the application of new NDAS on the entity's financial statement is to be given. Framework of accounting policies. In absence of guidance in the accounting standard. Suppose, firstly, the accounting policy needs to be selected based on the accounting standard. Firstly, the company will check that these policies, the guidance is available on accounting standard or not. If the guidance is not available in accounting standard, then the company will look into the pronouncement issued by foreign accounting standard board like IASB, International Accounting Standard Board, or Financial Accounting Standard Board, that is International Accounting Standard Board. Company will check their guidance. If the guidance is also not available in the pronouncement issued by foreign authority, then the company will check the accounting prescribed by similar or other accounting board. Means if any other accounting board has prescribed that, then they will check. Then if also not applicable, the guidance is also not available there, then the company will apply the industry's practice. So if the accounting standard does not exist, then the company may follow other level of guidance issued by International Accounting Standard Board or Financial Accounting Standard Board. It means accounting standard, first the company will check the Indian accounting standard. If the guidance is not available there, then the company will check the pronouncement issued by foreign accounting standard. Then if the guidance is not available also in that pronouncement, then the company look into the accounting prescribed by similar or other accounting bodies. If the guidance is also not available, then the company will apply in industry practice. These are the hierarchies by which the company can change its policy. Company can change its policy by following the above framework if there is no guidance available in accounting standard, but only subject to the fulfillment of conditions. Company can change its policy if the standard is not, if the guidance is not available. Company can adopt other pronouncement, other guidance also, other bodies guidance also, only if it will not present in the Indian accounting standard, and that application with the company is made in the financial statement only subject to the following condition, subject to the fulfillment of the condition. Disclosures regarding the change in accounting policies. I am just giving some of the example how the company has make a disclosure of change regarding in relation to the accounting policies. Some of the example of disclosures related to change in accounting policies are the title of index. Title of index, which index is following, the company needs to disclose. If the change is accounting policy made as per the transitional provision, if the company is making a change in policy due to the adaptation of new standard, then transitional provision as made as per the transitional provision. Nature of the change in accounting policy, what kind of accounting policy, then nature is to be disclosed. Then description of transitional provisions. What description? Whether it is related to Ind AS 115, Ind AS 116, Ind AS or new policies which is the or new standard which the company has adopted. Um, Application of transitional provision with effect. What was the application? If the company has make an application of transitional provision, what was its effect in the future period with effects future period with effects in future period, it should be disclosed. Current period and prior period, to the extent practicable amount of adjustment is to be presented. What adjustment the company has made in the current period and prior period, it should be disclosed. And earning per share is to be restated. So what is accounting estimates? Accounting estimates is a kind of judgment which is used in the presentation or recording of the accounting transaction in the financial statement. It should be disclosed in the financial statement. This judgment, if company has make any estimate, it should be disclosed in the financial statement. And these estimates need in every year basis, it should be reviewed on year to year basis. The estimates which the company has applied in the financial statement is to be reviewed on year to year basis. So these are the estimates which is a kind of judgment which the company take in the current year for for its future period. The estimates which the company is make what the expenses to be incurred in future, and that expenses is to be accounted in the current period. Provision for doubtful debt, that is uncertain. The estimate is not certain, that is uncertainty is there. The companies make that estimation on the basis of only on the basis of judgment. The estimates are not certain whether it happens or not. It's not actual. Provision for doubtful debt. The examples of estimates are useful life of PPE. Provision for doubtful debt means company has make a provision of 10% on debtors is to be created by the company. Provision for slow moving of inventory, that is for provision for obsolescence. So company has created 5% of all inventories as provision for obsolescence. Suppose company has some old inventories lying in the stock, so company has know that it is a slow moving inventory, so we will make a provision of that inventory as a provision for obsolescence. So it's a requirement that company has made that provision, and these are the examples of estimates. This is not actual. It may be, suppose the company has making a provision of 5%, but it may be 10% or less than 5%. It may be more than 5% or less than actually, but the company has make a provision of that. Actuarial valuation of gratuity and leave encashment. The suppose company discount rate is for valuation of its gratuity and leave encashment is 8%. That is not actual. That is on estimation basis. It means change in accounting formula shall be considered as change in accounting policy and not change in accounting estimate. If there is a change in accounting formula in calculation of valuation of the gratuities or leave encashment, that should be, means if any change in the formula, that should be considered as change in accounting policy. It should not be considered as a change in estimates. But discount rate is 8%, and that is treated as an accounting estimate because the discount rate is on estimation basis. It is not actual. What was its treatment of change in accounting estimates in the financial statement? Change in accounting estimates to be accounted prospectively. It means that it should be accounted in the current and future year balance sheet, not retrospectively. Change in accounting policies is to be accounted as retrospectively, but change in accounting estimates is to be accounted prospectively, not retrospectively. So estimates is to be accounted prospectively, means in current year and in the future period. Such changes shall be adjusted in the value of assets, liabilities, equity, and its corresponding impact in the P&L. What is an error? Definition of error. Error are the misstatement. These are the misstatement. Omission in recording of a particular transaction in the financial statement. Errors are misstatement or omission of recording of a particular transaction in the financial statement. Errors, for example, examples of error are mistakes in formula. If the company has make a mistake in adopting a formula, or there is an error in formula, then it is a kind of error. Error in respect of making a judgment. Mathematical error. Some error due to figure error, mathematical error, addition, subtraction. There is an error. These are the errors. Error in respect of making judgment in making decisions. Mistakes in formulas. Omission in recording of a particular transaction. And also error are occur due to fraud also. So these are the errors. Examples of errors. Errors are what? It is a misstatement, that is, or omission in recording of a particular transaction in the financial statement. Errors occur due to mistakes in formula, due to mathematical error, omission of recording of any important transaction, due to fraud, or error in respect of any judgmental error. Now it's treatment of error in the financial statement. How the company make its treatment of if any error has arises in the financial statement. How the company is accounting that error. How the effect of that error is to be accounted for. Error pertains to current year. If the company is finding any error which is related to current year, so its treatment should be given in the current year only before the approval of shareholders in the financial statement. Means prior to the approval of financial statement, the company has make its treatment or make its correction in the current year only. So the error pertain which is related to current year, it should be treated in the current year only. Error which relates to previous year, then the adjustment needs to be made in the previous year. Previous year figure is to be restated and appropriate disclosures is to be given. Means if error relates to the previous year, then the comparative figure is to be adjusted. It should be restated. Adjustment made in the previous year is to required to be made, and appropriate disclosure about the adjustment or restatement is to be given. Error which relates to prior to previous year. It means that if the error relates to current year, then adjustment is to be made in the current year only. If the error relates to previous year, then the adjustment made in the previous as a prior period adjustment, and the comparative figure is to be restated, and appropriate disclosures required to be given in the financial statement. If the error relates to period prior to previous year, then the adjustment needs to be made in the opening balance of the previous year, because three balance sheet required to be given at that time. If the error relates to the period prior to previous year, then three balance sheet required to be prepared, and adjustment needs to be given in the opening balance of the previous year. Third balance sheet needs to be presented. Opening retained earning of comparative years will be changed. Means retained earning of the comparative year figures will be changed, and appropriate disclosure in the financial statement is to be given. Please share, like and subscribe my channel. Thanking you for watching my video.